When you think of a budget, you probably picture a list of numbers that show your income from work or an allowance and all of your expenses, such as car payments, rent, or even video game subscriptions. Like a household, a company must also have a budget. Companies cannot grow without closely following a budget that accounts for expected income and expenses and helps them plan for the future. A master budget in accounting refers to a specific type of document based upon other specialized individual budgets. Individual budgets within a firm can change depending on the type of business. However, they frequently fall under one of the three main categories: operating budgets, capital expenditures budgets, and financial budgets. Operating budgets contain a sales, selling expense, and general and administrative budget. Companies that manufacture goods also have production and manufacturing budgets that include the number of units to be made and the costs associated with production. By comparison, companies that only sell products manufactured by others use a merchandise purchases budget to track the number of units it needs to purchase over time to cover expected sales. The sales budget includes the expected number of sales and projected income for the upcoming period in months, quarters, or years. Companies typically complete this budget first, as it allows them to estimate how much income is available to meet corporate goals. The selling expense budget commonly follows the sales budget. It records the estimated income and predicts expenses directly related to the sale of goods. Examples of direct sales expenses include sales commissions, sales managers' salaries, and advertising expenses. Expenses not directly related to the sale of particular items are accounted for in the general and administrative budget. Costs such as facility rentals, administrative personnel salaries, depreciation expenses, and shared utilities can be found in this budget. Capital expenditures budgets track any money that a business receives from selling large plant assets and buying new equipment to carry out production schedules. Typically, companies try not to keep a lot of cash in their accounts because it doesn't generate a lot, if any, revenue. Planning for large expenditures helps firms decide how they will pay for major equipment upgrades, additional facilities, or other related expenses. This budgetary section may be left out if the company does not have any income or expected expenses related to capital expenditures. Financial budgets include the cash budget, budgeted income statement, and budgeted balance sheet. Cash budgets track the expected income and spending of cash over an upcoming period of time to ensure that a company has enough cash on hand to meet future needs. As previously stated, companies do not like to keep too much cash on hand, especially when the money could be better spent by expanding products, services, and/or a customer base. Budgeted income statements attempt to predict how much a company will earn from sales and how much it will pay in expenses related to those sales. The development of a budgeted income statement is one of the last steps in the master budget process because it incorporates the other budgets. Budgeted balance sheets constitute the final part of a master budget and provide a summary of the company's expected financial status at a future date. Like the budgeted income statement, the budgeted balance sheet uses information from the other budget components. A master budget is actually a combination of many other budgets developed by different departments across an organization. Master budgets typically fall into one of three categories: operating budgets, capital expenditures budgets, and financial budgets. Operating budgets include a general and administrative budget, sales budget, and selling budget. Financial budgets include the cash budget, budgeted income statements, and budgeted balance sheets. Capital expenditures budgets track any money that a business receives and may not be included in every budget. The results show a financial picture of what a company expects to achieve over the course of an upcoming period of time. Information of great use to managers making both long-term and short-term corporate decisions.
You're the head of accounting for a large business, and it's time to present the budget to the board of directors. In addition to all the usual hesitation you feel about speaking in front of people who have complete and utter control over your job, you also can't help but feel that the world of numbers may be lost upon them. After all, they're all very busy individuals, and they may not be as impressed by the sea of numbers as you are. Luckily, you have a solution. Yes, you still have to provide a detailed budget featuring breakdowns by department and by quarter. However, on top of it all, you have a secret weapon. By using a master budget, you can give the board exactly what it wants, a concise but complete view of all the numbers for the organization. And you'll put this master budget together by assembling all of the other budgets throughout the organization. That ability to quickly look at a single page and get an idea of the financial state of an organization is a key reason to have a master budget. However, you don't just need to be concise for management and the board of directors. Think about your stockholders. Don't they deserve an easy way of seeing how much money the firm is making? And what about the regulatory agencies to which businesses have to report their financial paperwork? The first page of a typical master budget, the overview, provides just such summary information. Furthermore, by producing a master budget, you can give everyone within the organization a sense of their piece of the action. As a result, they can have a good idea of the state of the firm so that they can make their own proposals more useful. For example, if your firm is making plenty in profits, department heads could use this information from the master budget to make bigger requests to increase their department's long-term efficiency. If your company was posting losses instead, such requests would come across as insensitive to the needs of the firm as a whole. As you might expect, there are plenty of parts that go into building a master budget. Let's take a few minutes to look at them now. We've already covered the overview, but that's typically just page 1. Next, you'd have the sales budget, which shows your expected sales for the term in question. Then you'd have the production budget, which shows all the costs associated with production. Often, this is broken into 3 parts. The direct labor budget, which shows the costs of labor for production only, the direct materials budget, which shows costs of materials for production only, and the manufacturer overhead budget, which shows any overhead costs associated with manufacturing goods. But wait, there's more. The ending finished goods inventory budget allows us to figure out how much to charge for each good to make a profit based on the existing figures, while the cash budget makes sure we're using our cash on hand efficiently. Further still is the selling and administrative expense budget, which takes into account all expenses not associated with manufacturing goods. And finally, the budgeted income statement shows whether a company has the financial ability to do what it needs to do, while a balance sheet concisely lists any and all assets and liabilities to the company. For the most part, building a master budget just means putting various other budgets together from other departments. However, you still have to make sure that your overview is concise and accurate, since this is the one part that's unique to the master budget. This is the page where everything gets boiled down to just a few figures. Simply put, you have to be able to account for every dollar that passes through the organization within the given time frame. Often that time frame is a year, but many firms also prepare master budgets for each quarter. Once you have all of those departmental figures, as well as any knowledge of overhead costs common to all departments, it's time to crunch the numbers as simply as you can. Start with your beginning cash, then add your net profit plus any capital changes and depreciation. Next, subtract any capital expenditures, and you'll end up with your ending cash. Do this for each quarter, or for each month if doing a quarterly master budget, and you're done. The resulting overview of the budget is very useful as a quick guide for your staff. But wait, what are those things you subtract and add? Net profit is simply how much money your company actually made over the course of the period. If you made money, you add it to the balance sheet. If you lost money, then you subtract the amount lost. Positive capital changes refer to any capital goods that suddenly gained value. More often than not, this is if the value of the land your business holds goes up. Both of those make sense, so why is depreciation added? Remember that this refers to accumulated depreciation, which always has to be positive because you're still getting use out of the good that's depreciating. Finally, capital expenditures are those costs that come as a result of having to make major improvements, such as buying new land or building a new factory. This is particularly important. A big capital expenditure may result in a lower bottom line, but one that's nowhere near as much of a concern as one caused by net losses. In this lesson, we took a look at the importance of having a master budget. A master budget allows us to quickly and easily see the bottom line of a business, as well as have access to all of the important figures for that company. Not only is this information useful to outsiders like investors or the board of directors, but it also helps the department heads see the overall health of the business. Remember that the master budget factors in beginning cash on hand, net profits, depreciation, capital changes, and capital expenditures.
In flexible budgeting, a budget has scenarios for different potential volume levels. During the year, a company compares its actual results to the budget scenario that's most appropriate based on the actual volume of activity. The process of preparing a flexible budget is very similar to the traditional static budget process. Let's assume that you are a small business owner and need to prepare a budget for your aquarium company for the next fiscal year. In the past, you've had years where you received a few large orders that made it look like you were over budget in almost every category, and other years where volume was short and you wondered if the decreases in operating costs were appropriate for the change in volume. So, you've decided to give flexible budgeting a try this year instead. The first step is to prepare a budget at your most likely sales level. Let's say you anticipate selling 50 of your large aquariums next year. They sell for $1,000 each and cost you $550 each to produce. So you predict you'll have sales of $1,000 times 50 units or $50,000 and cost to produce them of $550 times 50 units or $27,500. In addition, you have rent expenses of $6,000 for the year and selling costs of $12,000. Now, when you think back to prior years, in a bad year you might only sell 40 units. In a good year, 60 would be possible. So now, you create budget scenarios at the 40 and 60 units levels of sales. When sales changes, your cost of production will change also, but your rent doesn't change. In this case, you're also paying a flat rate to a part-time salesperson, so selling costs won't vary either. As you start the year, you'll compare your actual results against the 50 units most likely scenario. But if things change and another scenario becomes more likely, you'll switch to one of the other budget scenarios so that your comparisons are more accurate. A static budget can give misleading results when volume varies from projections. If actual volume is higher than planned, then costs will be higher, which is generally considered a negative result even though you are selling more. If actual volume is lower than planned, then costs will be lower, which looks like a good thing, but may not be if your sales are down. Flexible budgets have the advantage of adjusting for changes in volume so that your budget to actual comparison is more useful in managing your business. It is also easier to analyze manager performance when costs shown are appropriate for the volume of business conducted. In a static budget, higher sales generally result in higher costs, and it is difficult to tell if the higher costs are appropriate for the sales level achieved. A flexible budget also estimates cost and profitability for different sales levels, which can aid in decisions such as whether to accept a large, unanticipated order. In summary, flexible budgeting is a budget that has scenarios for different potential volume levels. The process of preparing a flexible budget is very similar to the traditional static budget process, but flexible budgets have the advantage of adjusting for changes in volume so that your budget to actual comparison is more useful in managing your business.
The typical business cycle includes making or purchasing a product, selling it, and collecting the proceeds from the sale. The business that can collect more money than it spends has a better chance of survival. For this reason, it is vital that a business knows how to measure and manage its costs. While there are different types of costs incurred by a business, such as production costs, administrative costs, and selling costs, in this lesson we are concerned only with production costs. There are also different approaches to computing these costs, but here we will address only the standard cost method. A company may use cost information in a variety of ways, but it is typically used to analyze why profits have changed. For example, ABC Company has introduced a new product, and the selling price was set to match that of its competitors. However, after a few months of offering this new product, ABC Company noticed declining profits. In an effort to identify the source of the issue and correct it, management has turned to its accounting staff for answers. The accountants knew that any explanation for dwindling profits would require measuring the gross profit on each item. Gross profit is the amount of the sale that is available to cover the operating costs for the company. It is computed by subtracting the cost of production from the selling price. ABC's selling price was readily available, but the cost information was not. Due to the absence of this critical component, the accountants had to determine an appropriate method of computing the cost of each item. After careful analysis, the accounting team chose a standard cost approach. In order to understand this method, we must first define standard cost. Cost is the monetary measurement of the resources used in the production of an item. Those resources generally include raw materials, labor, and overhead. The estimated or expected value of the resources consumed in the production of an item is known as its standard cost. Deviations from this standard are known as variances, either favorable, such as when actual cost is less than standard cost, or unfavorable, such as when actual cost exceeds the standard. The accountants for ABC discovered the following data for its new product. This product consists of 4 units of raw material A and 3 units of raw material B. It requires 5 hours of labor to assemble at an hourly labor rate of $12. The cost of the equipment and facility allocated to the manufacture of this product is $2 each. The acquisition of raw materials A and B is $1 and $2 respectively. Based on this information, the accountants computed the standard cost of the product as follows. Raw materials cost, which measures the value of components used to produce a product, equals 4 times $1 plus 3 times $2, or $10 per unit. Direct labor cost, which measures the value of labor used in assembling the product, equals 5 times $12, or $60 per unit. Overhead cost, which measures the value of plant, equipment, and administration, is allocated to the production of an item, equals $2 per unit. Therefore, the total cost of the product is $72, or $10 plus $60 plus $2. Once the accountants arrived at the expected or standard cost, they are in a position to do a number of analyses. A common analysis is the comparison of the selling price to the standard cost to determine if there is a gross profit. When the selling price is less than the cost, ABC is incurring a loss on the sale of each unit. Management could use this information to develop a different marketing strategy. Another benefit of standard costing is that it allows variance analysis. This involves comparisons of the standard costs to the actual costs. As computed, the labor standard was 5 hours at $12 per hour. However, what if an inexperienced worker took 5.5 hours to assemble the product instead of the standard allowed of 5 hours? The actual cost of labor would then be 5.5 times 12, or $66, instead of the $60 allowed. Therefore, ABC would have an unfavorable labor variance of $6, 66 minus 60. Management could use this data to make improvements in its production process. Another application of a standard cost system is the ability to project future needs based upon volume of production. This utility is essential in creating budgets in the manufacturing environment. With this information, management could determine how many production people to hire or how much warehouse space would be required for storage. In this lesson, we identified the concept of standard costing as the expected value of resources attributed to an item produced. This valuable measurement is important for a number of reasons. First, it allows a foundation from which the sales and marketing teams may determine a profitable sale price of the item. Second, it allows the production team to measure production efficiency through variance analysis. Finally, it gives management a platform for establishing budgets for the future by providing the ability to forecast cash flow on various production volumes.
Have you ever made a budget? Unless you're much better at remembering exact costs than most people, you likely put down some estimates for things like transportation and food. After all, you probably don't drive exactly the same number of miles every day in the same conditions, nor do you eat the exact thing every day that never fluctuates in price. In short, you probably put some estimates down. If you stuck with your budget, over time you'd likely try to get a more precise idea of how much you spend on each category. In short, you'd be trying to establish a standard cost for something. A standard cost is the amount that you expect to spend on a given good or service. In this lesson, we're going to look at why this is such an important concept for businesses, as well as how to set standard costs and how to deal with variations when they emerge. Planning on how much to spend at the grocery store is actually a great example of why companies seek to establish standard costs. Let's say that your family of 4 tries to spend no more than $700 a month at the grocery store. If everyone who buys food in your house is aware of that being the budget, then the chances of someone coming home with lobster and steaks 3 nights a week is reduced. By using standard costs, companies also seek to educate their employees on how much is a reasonable amount to spend. Standard costs can act as guidelines for how much should be spent on hotel rooms, copy paper, and any other number of supplies. Additionally, by agreeing to spend $700 a month at the grocery store, your family was then able to budget accordingly. After all, food expenses shouldn't exceed that $700. Likewise, companies are able to plan their own expenses better if they have a solid idea of how much they should be spending. However, how does a company set standard costs? That $700 per month figure for food costs comes from the USDA's website. However, companies have to try a little bit harder to understand their costs. Standard costs have three major components, all of which are added together to find the final standard costs. Standard direct labor costs are the costs associated with producing a product. For this, you multiply the standard rate of pay by the number of hours needed for a project. Second, we have standard materials cost. Multiply the cost of each unit of materials by the number of units of materials needed. Finally, there is the overhead standard cost. Multiply the overhead cost per unit by the number of units, and then add any fixed overhead costs. Add all three of these together to get the final standard cost.
Abigail is the plant manager at a women's coat factory. Now that the weather has turned colder, she's ready to take a new look at the standard costs of making a woman's coat. This will make it easier for her to budget and compare with actual performance to see how the factory is doing. It will also help her set her prices if they need to be changed and estimate the value of her inventory. She's been walking around the factory a lot and talking to her supervisors and employees about how much material is in a coat and how long it takes to sew it together. She finds out that there are 2 yards of material in a coat and that it takes a seamstress 1 hour to sew it together. She buys material for $6 per yard and pays her workers $15 per hour. She finds out from accounting that there is 3/4 of an hour of overhead time at $8 per hour in each coat. That will pay the janitor and keep the factory warm. Now she's ready to do the standard costs. The table looks like this. So there it is. It should cost Abigail $33 to make 1 coat. She's planning a production run of 500 coats this month, and that should cost her 500 times $33, which is $16,500 to make them. Since she's selling them to retailers for $55, she will bring in $27,500 in revenue, and $27,500 minus $16,500 equals $11,000 in profits.
In this lesson, we looked at the importance of standard costs for companies. Remember that a standard cost is the amount that you expect to pay for a good or service, especially when it comes to creating something. We compared standard costs to the ability of a household to budget food costs for a month. Through this, we saw how it acts both as a guideline for appropriate spending habits for those who may not purchase routinely, as well as a better way to plan for future spending. To find the standard cost, we add the standard labor cost, the standard materials cost, and the standard overhead cost.
By now, there's probably a pretty good chance that you know what a variance is in accounting. In case you forgot, a variance is the difference between the budgeted amount and the actual amount that was spent on a good, service, or action. As you probably also know, variances are a big deal to businesses because they help you figure out where budgets go wrong. As anyone knows who has ever tried to manage a household budget and found that the electricity bill was twice as much as planned, being able to track variances is a valuable skill. You can do this more effectively with variance analysis modeling, by which we track variances over time to notice any trends that are developing. In this lesson, we'll apply variance analysis modeling to 3 different categories of variances, providing examples of where each can happen along the way. First of all, let's start with variance analysis modeling of direct materials variances. Remember that direct materials variances occur when the budgeted amount for materials differs from what was actually spent. To do this, we first of all need our variances. To keep things simple, let's only track 3 different times, and we'll look at total materials as a whole. Here's our chart. Notice how each time the variance gets more and more favorable until it is once again positive. Remember that a positive number is a favorable variance, in which the company saved money, while a negative number is an unfavorable variance, in which the company lost money. The bigger the number, the further off your budget was. As you move towards 0, you're becoming more accurate and are better able to allocate resources to get more done. If you wanted to, you could graph this knowledge, but I think it's pretty apparent that whoever is doing the budgeting for the direct materials is mindful of limiting variances and providing the best information possible. Now, let's look at variance analysis modeling of direct labor variances. Remember that direct labor variances only apply to labor variances that are directly related to the manufacture of goods or services. Once again, a chart will be really helpful here. Here, we have a very different situation. Every quarter, the variance is more and more favorable, but it also keeps getting bigger. This time, it's a bit more complicated. On the one hand, you may be tempted to praise the manager for lowering labor costs. However, by not reporting the changes in variance, the manager is making the whole organization less effective. Finally, let's look at variance analysis modeling of overhead variances. Remember that overhead variances apply to all those variances that are not directly related to the production of a good. For example, an accounting department is an overhead expense. Once again, here's our chart. Whoa, these numbers are all over the place. When we apply variance analysis modeling to that set, we don't get a neat answer like we did earlier. Instead, we're left with more questions. Why are the variances bouncing around so much? Is it just a crazy market, or is there an inefficiency in the organization? In any event, variance analysis modeling gives you more useful questions and a way to find more answers. Okay, let's review. Variance analysis modeling lets us examine variances within an organization's budgets to find just how well a department or company is responding to updated information. In this lesson, we focused mainly on direct labor variances, direct materials variances, and overhead variances.
Management by exception is a management system where business results are compared against the results that were either budgeted or planned. Unlike other type of management systems, management by exception means that management intervenes in daily operations only if there is a deviation or variance between the actual results and the planned results. Minor deviations may be brought to the attention of low-level supervisors, while huge deviations may be shot straight up to the top levels of management. This, theoretically, allows managers to focus on the most pressing and important issues and problems. For example, if productivity goals are being met, managers are busy dealing with other problems rather than walking around the production floor monitoring activity. One of the most important tools used in management by exception is variance analysis. Variance analysis is a process that is used to determine the variance or difference between the actual results and the planned for results and the cause of the difference. In other words, it's the technique used to determine whether there is a problem needing management's attention when managing by exception. Let's look at a quick example of management by exception and the use of variance analysis. Edward is an accountant that is responsible for tracking the production costs for his company's production division, which produces toys. Edward's company has launched a new toy line. The cost per unit of production was budgeted during the beginning of the project. In reviewing the monthly invoices and receipts, Edward has determined that the production division is 10% over budget on the new toy. Company procedure only gives him authority to address overages of 5%, so he must bring this issue to his manager, Marty. Marty has the authority to investigate and address variances of up to 10%. He investigates and determines that about a third of the variance was due to an unexpected increase in the price of one of the commodities used in production. The other 2/3 of the variance were related to price increases from some suppliers that are out of line with market prices. Edward's manager meets with the company's purchasing agent to discuss alternative vendors to correct the variance. Managing by exception has some distinct advantages. Let's look at some. Management is able to focus on pressing problems rather than micromanaging the day-to-day operations. Problems are triaged at the appropriate level based upon the degree of variance, permitting a more efficient use of time for management at all levels of the management hierarchy. Employees are left to handle day-to-day operations, free from micromanagement, which can provide job satisfaction. Managing by exception is not without disadvantages. It assumes that only management can effectively deal with variances, even though non-management employees may be capable and more suited to do so because they are on the ground. If management only intervenes when there is a bad variance, it can be very demoralizing to employees. It's important that management intervene when positive variances, such as higher than expected sales revenue, occur through recognition of the achievement and other types of positive reinforcement to motivate employees. Management may become isolated from day-to-day operations, and employees may feel isolated from management due to low interaction. Let's review what we've learned. Management by exception is a system of management where managers only intervene if actual results vary from expected results. Variance analysis is a tool used in management by exception to determine differences in expected and actual results. Management by exception presents both advantages and disadvantages. Advantages include letting management focus on the bigger issues and problems and letting employees deal with the day-to-day operations. Disadvantages include the assumption that employees can't effectively address variances. The management system also may isolate employees from management and management from daily operations. Additionally, if the focus is only on mistakes, it can lead to low employee morale.
The Timeless Book Den has 3 departments: mystery, classics, and comics. Its owner, Mr. Reed, knows his business is profitable overall, but he would like better information on the profitability of each of his segments. Let's examine how we can help Mr. Reed with his objective. Businesses are required to produce financial information that reports the profitability of the overall business on a regular basis. While this information is useful, it doesn't provide management with information to assess the profitability of individual divisions or departments. Segment reporting provides management with information on a division or department's revenue and expenses, both variable and fixed, and profitability. This information allows management to make decisions about discontinuing a product or department, or making changes to improve profitability. Revenue represents the amount of money earned by a company by selling its goods and services. Variable costs are expenses that vary with the level of activity. Examples include hydropower costs and the cost of labor used to manufacture a product. Fixed costs are those costs that remain the same despite the level of activity. An example would be rent that a company pays on its production facility. Fixed costs can be classified as either traceable or common. Traceable fixed costs are those that can be traced directly to a particular segment or division. An example of a traceable fixed cost would be the salary of a supervisor in a particular department. Common fixed costs are those costs that would be incurred whether the segment or division operates or not. An example would be rent, as it would still need to be paid if there were 2 divisions or 3 divisions. An income statement is a financial statement that shows a company's revenues, expenses, and net income, which is the difference between revenues and expenses. A segmented income statement separates the revenues and expenses by department so that the profitability of each area can be determined. In order to determine the profitability of a particular department or segment, it's useful to prepare an income statement that includes the contribution margin. The contribution margin is the difference between sales and variable costs, and it represents the markup or profit earned before fixed costs are deducted. A department should have a positive contribution margin if it's to continue operating. Let's examine the contribution margin income statement for the Timeless Book Den. The segmented income statement shows that while the Timeless Book Den has a net income of $3,100 overall, the Classics department lost $500 during the month. Even though it lost money overall, the Classics department has a positive contribution margin. Contribution margin equals sales minus variable costs. This means the Classics department is still contributing to fixed costs and overall profitability. Just using the net loss information might lead Mr. Reed to conclude that he should close the Classics department and leave the other two departments open. However, he needs to look more closely at his fixed costs before making this decision. The traceable costs of $1,200 might disappear if the Classics department were to close. Here, we're assuming that they are all avoidable, which means they won't be incurred if the department closes. However, the common fixed costs of $800 would need to be allocated to the two remaining departments, Mystery and Comics. The segmented income statement in this situation would look like this. If Mr. Reed decides to close the Classics department, his overall profitability would decrease by $300. $3,100 in net income minus $2,800 in net income equals $300. Notice that the common fixed costs of the Mystery and Comics departments have increased by $400 each, as the $800 of costs from the Classics department must be allocated to the two remaining departments. Mr. Reed would also want to examine factors other than profitability when trying to decide about closing a department. For example, would closing the Classics department hurt his sales in the other two departments? Perhaps his customers buy books in all three departments, and closing one of the departments might result in some customers deciding to shop elsewhere. Mr. Reed would also want to consider if he could use the floor space currently occupied by Classics to expand the two remaining departments. If there is customer demand for more mystery and comic books, then this strategy might make sense. Mr. Reed would also want to consider whether the traceable fixed costs are in fact avoidable. If the Classics department closes, Mr. Reed would not need to pay the salary of the manager of that department, and her salary would be saved. If, however, some of the traceable fixed costs include costs that would not disappear if the department were to close, such as depreciation, which recognizes the cost of using assets over their useful lives, then Mr. Reed would not be saving as much money by closing the department as he originally anticipated. Preparing a segmented income statement helps management determine the profitability of individual departments or divisions. Calculating a contribution margin for each department reveals if a segment has profit to contribute to covering fixed costs and overall profit. Calculation margin equals sales minus variable costs. Fixed costs, or costs that remain the same regardless of activity level, must be examined to determine if they are traceable or common. Traceable fixed costs, or costs traced directly to a particular segment or division, could disappear if a department were to close, if they were avoidable. However, common fixed costs, or costs that would be incurred whether the segment or division operates or not, such as for items like rent, would still be incurred and must be allocated to remaining divisions. Mr. Green operates Lawns R Us in his hometown. He currently offers lawn mowing, aeration, and landscaping services to his clients. Despite his marketing efforts, he has not been successful in getting customers to take advantage of his aeration services and is wondering if he should close that part of his business. Let's examine the factors that Mr. Green needs to consider before making this decision. All businesses incur costs in order to generate sales, and these costs can be separated into variable and fixed costs. Variable costs are those costs that vary with the amount of activity. For example, the more lawns that Lawns R Us mows, the more direct labor costs it will incur, as more people will need to be hired to complete the work. Fixed costs are those costs that do not fluctuate with the amount of activity. The rent that Mr. Green must pay for his office building would be an example of a fixed cost, as rent will cost the same whether Lawns R Us mows 1 lawn or 100 lawns monthly. Fixed costs can be subdivided into those costs that are avoidable and those that are unavoidable. Unavoidable fixed costs are those costs incurred regardless of how many business segments are operating. Mr. Green's rent expense is also an example of an unavoidable fixed cost. Whether he operates 1 segment or 3 segments, he'll still need to pay the same rent, assuming he can't downsize his office space. Unavoidable fixed cost is one that would not be incurred if a particular segment were not operating. For example, If Mr. Green decided to stop offering aerating services, the salary paid to administrative staff working in this department would be saved. In order to calculate his business, Mr. Green would want to calculate the contribution margin for each of the 3 segments. Contribution margin represents the amount of money a business has left over after deducting variable costs to cover its fixed costs and contribute to profit. The formula for calculating contribution margin is sales minus variable costs. Let's examine the contribution margin for each of Mr. Green's 3 segments. We can see that the contribution margin for each segment is positive, which means it's contributing to covering fixed costs and profits. If we only examined contribution margin, we would conclude that there were no issues. However, if Mr. Green wanted to examine how profitable each segment was, he would need to look at the segment margin. The segment margin takes into consideration all costs that can be traced directly to a particular line or segment of business. It includes variable costs as well as avoidable fixed costs that can be traced to an individual segment. Unavoidable fixed costs are not included in the calculation of the segment margin, as they're usually allocated to each segment based on a predetermined percentage. The formula for calculating segment margin is sales minus variable costs minus avoidable fixed costs per segment. Let's review the segment margin for each of Mr. Green's 3 segments: lawn mowing, landscaping, and aerating. By examining the segment margin and operating profit on the segmented income statement, Mr. Green can determine that although his aerating business is losing money overall, $4,000 loss, its segment margin is still positive, which means it's still contributing $2,000 toward the company's overall fixed costs. We can see that the overall operating profit is $17,000 when all 3 segments are operating. If Mr. Green were to close the aerating business, he would not incur the $6,000 in avoidable fixed costs, as the administrative staff who support the business would no longer be needed, but the $6,000 of unavoidable fixed costs would have to be allocated to the 2 remaining businesses, lawn mowing and landscaping. In this situation, overall operating profit would be reduced to $15,000. $16,000 for lawn mowing plus $5,000 for landscaping minus $6,000 additional allocation of unavoidable fixed costs from aerating, which is $2,000 less than the $17,000 operating profit when all 3 segments are operating. It would not be wise for Mr. Green to shut down the aerating business, as he will earn $2,000 less profit overall. Mr. Green must also consider that operating aerating services may bring in sales for the other 2 divisions. By closing the aerating business, Mr. Green may lose customers for lawn mowing and landscaping services, which would decrease the total sales for Lawns R Us. In order for the segment margin to be calculated, management must ensure it has identified all costs by segment, correctly identified fixed costs as avoidable or unavoidable, and allocated unavoidable fixed costs on a basis that accurately reflects the usage by the individual segments. A failure to accurately allocate or identify costs may result in an inaccurate calculation of segment margin, which could lead management to make an incorrect decision about whether to keep a segment open or to close it. Fixed costs and variable costs must be taken into consideration when evaluating whether to continue running a business segment. Calculating the contribution margin for each unit will help identify if a particular segment is contributing to fixed costs and profit, and calculating the segment margin provides a better measure of profitability. To calculate the segment margin, a business must determine which fixed costs are avoidable versus unavoidable, as only the avoidable costs are considered in this calculation. Even in situations where a segment margin is negative, a business must consider the impact that closing that segment would have on its other segments before making a final decision.
One of the biggest assets that a company has is its people. Effective employees and managers are worth several times more than their salaries and benefits. As you might expect, the ability to have some sort of accounting system to track these performers is, therefore, not only useful from a financial perspective, but also to aid in managing talent. That is exactly what responsibility accounting does. Rather than focus solely on monolithic entities like legal or HR, responsibility accounting tracks expenses and revenues through individual managers and the areas that they supervise. As you might imagine, responsibility accounting has some pretty considerable advantages all around. First of all, it allows for upper management and accountants to gain unique insight into how resources and information move around an organization. With other systems, different departments are walled off. However, with responsibility accounting, different departments are linked to each other in organizational chains. Additionally, there are incredible HR benefits. For example, talented managers can be identified earlier because responsibility accounting includes reports from all levels of management on up. Therefore, a standout employee whose immediate supervisor may not recognize as having great potential can be seen by others in the company. Finally, responsibility accounting provides a level of timely accountability to the company. Reports for each manager have to be prepared each month. These show how efficiently the manager handled their section of the company, and they're then aggregated up to the highest levels of management. Still, there are plenty of disadvantages to the responsibility accounting system. If you started thinking of the whole system like a bunch of tubes or chains, you wouldn't be the first. As you might expect, this tends to make people act more vertically, which limits their creative abilities. A great new business practice may have emerged if segments from two different teams had been allowed to collaborate together, but under responsibility accounting, these opportunities are often missed. Also, responsibility accounting makes it more difficult to divide up responsibilities that are shared between departments. It's easy to assign a sales team to a given manager, but who's responsible for the work of the retention group of customer relations? This group has to work to maintain customer relationships and act like a sales group, but they're definitely in customer service. Finally, responsibility accounting creates a certain amount of competition between managers. While it's unfair to say that a person's entire career can come down to their performance under responsibility accounting, it's definitely fair to say that managers who look better on paper stand a much better chance of investment from the company. This is unlike other organizations that may interpret individuals' performances differently by taking into account soft skills that don't emerge on spreadsheets. In this lesson, we looked at responsibility accounting. Starting with the CEO of a company, every person has to turn in a report every month that shows how they have used the resources allocated to them for the betterment of the company. This allows for gifted managers to be identified earlier and helps track relevant spending amongst product divisions. However, it can also limit collaboration and give rise to managers who may lack the soft skills that actually make them gifted leaders.
If you've been learning about accounting for very long, you're probably familiar with many of the different types of responsibility centers, those parts of a company that are tasked with something that can be accounted for. One of the most important of these is the investment center. This is a responsibility center that's charged with making money like a profit center. However, unlike a profit center, an investment center is allowed to spend money to make money. In this respect, it's quite a bit more complicated to evaluate than a profit center, where we can just look at the bottom line. In this lesson, we'll look at how to evaluate investment centers. Remember that an investment center can both spend money and make money. This makes a difference when it's being evaluated. After all, an investment center that makes $1 million in a month may be a great investment center for a small business, but only if it doesn't have $1 million in expenses. With this in mind, we can look at two different numbers when evaluating investment centers. In this lesson, we'll explain both of them. First, we look at the return on investment. Second, we examine residual income. Most investment centers simply analyze return on investment to prove that they're doing well. The return on investment is a ratio that shows just how profitable a division is. To calculate it, we divide the operating income of an investment center by the operating assets. The operating income is the money that the division made during that month, while the operating assets are all the assets that the company had to assign to the investment center during that time. The higher the return on investment, the better an investment center has performed. Sometimes companies prefer to use the residual income method of evaluating an investment center. This provides a measure of how much more an investment center makes over its target rate of return. After all, companies don't just throw money at investment centers blindly. They have defined goals in the form of a planned rate of return on investment. To find the residual income, first we multiply the operating assets by the target rate of return. That tells us how much we expect to make every period. Then we subtract that amount from the operating income of the investment center. This shows us how much profit on top of expected returns a company is making. Obviously, the higher the residual income, the happier management will be. But wait, when should we use which? Simply put, it depends. If we're comparing investments of differing sizes for relative effectiveness, then we want to use the return on investment model. After all, a percentage rate can be compared against another percentage rate. However, if we're just wanting to get a specific amount for this particular investment, we'd probably prefer to use the residual income method. To help all of this make more sense, let's try an example. Let's say that your company sets up a new product line to be its own investment center. As the manager, you'll be responsible for everything about it. $10 million goes into setting up your operation. You've spent all $10 million and are now ready to make a profit. $10 million constitutes the operating assets of your responsibility center. Luckily, you've turned a profit of $2 million. That's your operating income. So, $2 million divided by $10 million equals 0.2, or 20%. As such, you would have a return on investment of 20%. Not too shabby. The formula looks like this. Return on investment equals profit divided by investment. However, let's say that your firm uses the residual income method. As an investment center, your target rate of return is 15%. Let's take that 15% and multiply it by 10 million, which leaves us with $1.5 million. Remember, we multiply the target rate of return by the operating assets. Now, subtract that amount from the operating income, or $2 million. We then end up with $500,000. As you can see here, the residual income method tells us how much over or under we are from what we are expected to make, while the return on investment method just tells us what percentage of our investment we've made back. The math looks like 0.15 times $10 million equals $1.5 million. In this lesson, we looked at how to evaluate investment centers. As investment centers both spend and make money, they must be evaluated differently from other responsibility centers. We started by looking at the return on investment, which is the operating income of an investment center divided by operating assets. We then saw how to use the residual income method to find out how much money an investment center is making on top of that. To find the residual income, multiply the target rate of return on investment by the operating assets of the division. Then subtract that number from the operating income of the investment center.
Mr. People is the CEO of a nonprofit organization that provides meals to homeless students. He wants a tool to help him to monitor the performance of his organization and to help him make the best strategic decisions. Mr. People looked at the business management literature and discovered the Balanced Scorecard, a tool used by corporations to help their executives to be informed about the status of their companies and to make decisions. The Balanced Scorecard is a strategic planning and management system that provides summary details about key performances of an organization or company for its executives. The information reported in a balanced scorecard helps executives to know if their business activities are progressing in line with the vision and strategy of the organization. It's a flexible tool and can be adapted to meet the needs of an organization. A balanced scorecard can measure various tangible and intangible factors, such as finances, productivity, and even employee satisfaction. Many balanced scorecards also include target figures or goals. Reported figures are compared with estimates, typically in a table format over time. Decision makers use the differences, if any, to make adjustments. Balanced scorecards are generally updated on a regular basis at whatever time intervals are best for the organization, such as quarterly. Mr. People's nonprofit organization provides meals to homeless students. The strategic information that Mr. People has decided he needs is how many schools the nonprofit organization supports, how many students use the services of the organization, the financial snapshot of the organization, the financial goals of the organization, and how many workers and volunteers support the organization. The key indicators of program success can be measured over time. Presenting this information in a balanced scorecard format can make it easier to see which metrics meet target figures and see which metrics may need more attention. Now, let's say that Mr. People's organization is developing a new project. The organization is planning to offer used, donated clothing to the students. Balanced scorecard measurements can include some of the components required for setup of the new project. Mr. People can collect these figures and place them into a balanced scorecard report, and then follow the development of this new project. Once the new project is finalized and in operation, key measurements related to this new initiative can be worked into the organization's existing balanced scorecard. The balanced scorecard gives decision-makers an overview of company performance across several factors. Executives can follow up with their employees when they need more detailed information. In this strategic management system, the executives are the generalists. They use their understanding of the organization's vision and mission to make decisions using high-level summary information. The employees are the specialists who provide the summary information to the executives. A balanced scorecard is a tool used by corporations to help their executives to be informed about the status of their companies and to make decisions. It's also a way of reporting multiple types of figures so that one can get an overall picture of an organization, and it can also be used to manage specific projects. Executives can use balanced scorecards to measure the performance of their organization against mission and goal statements and assist in strategic planning and actions. These contributions are provided by every department in the company or organization, since they can shed light on different bits of information. Balanced scorecards must be updated regularly, usually on whatever interval works best for the company or organization. That means it could be weekly, monthly, quarterly, or yearly. It just depends on what the goals are, since every company is different. Thus, also why there's no such thing as a standardized balanced scorecard.
If you ever had a lemonade stand as a kid, you have thought about relevant and irrelevant costs. Say you are deciding whether you want to just sell lemonade, or you might sell lemonade and cookies at your stand. There are certain costs that will change with whichever you decide. The additional supplies that you would need to produce, transport, and sell your cookies instead of just selling lemonade are relevant costs. The cost of your lemonade stand, however, will stay the same. This is an irrelevant cost. Let's look at these costs in more detail. Relevant costs are those costs that change with each decision you make. If you have two choices and you choose A instead of B, relevant costs are the costs that will be different from those associated with choice B. These are costs that directly affect cash flow, the money coming in and going out of a business. Relevant costs include differential, avoidable, and opportunity costs. Differential costs are those costs that make up the difference between your available choices. If your costs are $150 for producing lemonade and your costs are $325 for selling lemonade and cookies, your differential costs are $175, 325 minus 150. Avoidable costs are those costs that are avoided by making one choice over another. If we choose to just sell lemonade at our stand, we will no longer need the costs of ingredients for cookies, access to an oven and kitchen tools, labor for creating the cookies, and electricity to heat the oven to make the cookies. These are avoidable costs. Opportunity costs are the revenues that are lost by choosing one decision over another. In our lemonade stand example, the money that you would make from also selling cookies is an opportunity cost of choosing to just sell lemonade. Say you would make $2,000 if you sold lemonade and cookies, but you'd only make $750 if you just sold lemonade. Your opportunity costs are $1,250, $2,000 minus $750, in cash flow. You will lose this money if you choose to sell only lemonade. Certain costs will not change when deciding whether to sell cookies. You will have these costs regardless of your decision. These are irrelevant costs. Irrelevant costs are those that will not change in the future when you make one decision versus another. They are costs that will continue to happen. Considering our lemonade stand, we will still have to squeeze lemons and maintain our lemonade stand regardless of whether we sell cookies or not. Irrelevant costs are things like sunk costs, which include the cost of the lemon squeezer, and fixed overhead costs, which would be the costs of maintaining the lemonade stand. Sunk costs are those costs that cannot be changed because they were from prior decisions. Typical examples are technology, machinery, tools, and vehicles. Fixed overhead costs are the costs needed to operate a business. Rent, insurance, and utilities are included here. Let's look at an example of relevant and irrelevant costs. A graphic design company is trying to decide whether to continue its home design branch. This division is new and only accounts for a small part of its revenue. If this branch is eliminated, certain costs will change in the future. Salaries from the graphic design branch, for example, will change because those in the home design department will be terminated. These are relevant costs. Let's also see what makes up our differential, avoidable, and opportunity costs. Differential costs are those costs that make up the difference between keeping the home design branch and eliminating it. If your costs are $150,000 for eliminating the branch, and your costs are $325,000 for keeping the branch, your differential costs are $175,000. Avoidable costs are those costs that are avoided by choosing to eliminate the home design branch versus keeping it. If we choose to eliminate the division, we will no longer have the costs of the employees' salaries, trucks to move materials, and licenses for home design software. These are avoidable costs. Opportunity costs are the revenues that are lost by choosing to keep the home design branch versus eliminating it. The money that you would make from continuing to do home design is an opportunity cost of choosing to eliminate it. Say you would make $1,250,000 if you kept the division, but you'd only make $1 million if you eliminated it. Your opportunity costs are $250,000. $1,250,000 minus $1 million in cash flow. You will lose this money if you choose to eliminate the branch. What is relevant for one situation may not be for another. What makes up our irrelevant costs in our example? Things that are fixed overhead costs like building rent and facility insurance are irrelevant costs. These costs will stay the same whether we keep our home design branch or eliminate it. Looking into our sunk and fixed overhead costs, we see that the salaries of those who work outside the division, costs of existing equipment, and rents paid to maintain the facility will not change. Therefore, these are irrelevant costs. To summarize, relevant costs and irrelevant costs in accounting, we learned that determining these costs depends on the situation. Differential, avoidable, and opportunity costs are considered relevant costs. Sunk and fixed overhead costs are irrelevant. Using examples to demonstrate these costs show us that which costs are included in what places depend on what decision is made and the specific situation. Businesses are constantly under pressure to make the best decisions possible. However, there is never a shortage of decisions to be made. From deciding whether or not to continue a product line, to deciding how to treat a joint product, companies are constantly trying to make sure that they are maximizing profits while minimizing costs. This lesson will examine decisions regarding starting or stopping production on a good, outsourcing, using a constrained resource, and understanding how joint product costs can help companies make even more money. A crucial role of business is that a company can only be expected to offer a product line if it is profitable. Depending on the stage of the product, this could mean different things. For a product that is just being introduced, the money made from its sale should be enough to cover variable costs, fixed costs, and make a profit. Meanwhile, if a good has been sold for a while and is facing discontinuation, a company should keep it around only if its sales price is greater than variable costs. That means that it is still contributing money towards fixed costs and profits. Finally, special orders should be treated like new product lines. They should only be pursued if they are profitable. Another decision that is driven by a desire to save money is whether to outsource or allow another company to perform one of your business functions. Here, the analysis is pretty simple. Can you save money by having someone else do it all for you? Distribution is often outsourced. After all, many of us look for only a small number of companies to deliver our packages. Some companies have their own delivery trucks, and this is profitable for them to do so. However, for many companies, the costs of maintaining warehouses, distribution centers, and trucks is simply too much. Instead, they find it cheaper to outsource these tasks. Let's say that you run an ice cream truck. It's the middle of summer, and freezer space on board is limited. In this instance, space is a constrained resource, because it is limited in availability. Of course, your ice cream varieties have different variable costs, and take up different amounts of space in your truck. For example, a box of 12 ice cream sandwiches takes up half the room as a box of 12 ice cream tacos. Yet while you can make a profit of $1 per ice cream sandwich, you can make $2.50 per ice cream taco. These numbers are known as the contribution margins. By dividing the contribution margin by the area taken up by each box, 1 cubic foot for ice cream sandwiches and 2 cubic feet for ice cream tacos, we can see that each cubic foot of space is most profitable when it is used to sell ice cream tacos. For an ice cream truck driver aiming for profits, that means telling kids that you're all out of ice cream sandwiches. Finally, we get to joint product costs. Joint product costs are those products that share a great deal of the production process. For example, many electronic tablets are jointly produced. The point at which they are differentiated, for example, with different memory capacities, is called the split-off point. This is the point where we can finally find different profit values for each. As a rule, we should concentrate on whichever side produces the greater profit. For example, let's say that you sold a tablet with 16 gigabytes of memory for $500 and one with 128 gigabytes for $1,000. The 128 gigabyte hard drive adds $600 to your base cost of $200, while the 16 gigabyte drive is free. As a result, it is more profitable for you to sell the 16 gigabyte tablet. In this lesson, we looked at how to use cost determination to make the best business decisions. In short, businesses should always seek to maximize profits while minimizing costs. Minimizing costs can occur by outsourcing, which means to allow another company to perform one of your business functions, or through eliminating product lines that are not profitable. Meanwhile, maximizing profits can be done by making smart use of both joint products and constrained resources. Remember that a constrained resource is one that is only available in limited quantities. Also, it is the contribution margin, or difference of price and variable cost, which helps us determine just how to make the best use of those constrained resources. Finally, we have to be careful when analyzing products with joint product costs, when they share a great deal of the production process, in order to make sure that we keep the split-off point, or place where the products have different profit values, in mind.
In a perfect world, Versace would be a great place to live. Unfortunately, it is not in the budget. Corporations, like people, are limited by their budgets. What do when you have a limited budget? You figure out the best ways to spend what you have to get what you need or want. For business, that may be new equipment. When corporations figure out ways to get what they need or want, it is called capital budgeting. So corporations conduct financial analysis to determine whether an investment or project is a good idea to pursue. Since the main purpose of a corporation is to make money, it is important to wisely choose which opportunities to pursue. There are several factors that a corporation needs to understand in order to make a capital budgeting decision. They need to understand their cash flow. This is the amount of money that goes into and out of a business. How much money do we have? Corporations also need to understand the financial implications of an investment. How will this capital expenditure, money spent on projects and investments, affect us now and in the future? Once they understand the financial implications of an investment, they need to understand whether it is a good investment for them. So they need to understand their criteria for making an investment. What do they hope to gain? How much do they want to spend? What outcome would make this a good or bad investment for them? There are several common techniques that corporations use to determine how money is spent. This lesson will discuss 3 techniques: payback period, net present value, and internal rate of return. The payback period is the easiest to calculate. A business that wanted to buy a new piece of equipment might use this technique to make a capital budgeting decision. The payback period is the amount of time that it takes for an investment or project to pay for itself. For instance, the equipment costs $5,000 to purchase and will potentially earn $1,000 in profits a month. The equipment will pay for itself in 5 months. How easy was that? You just need key pieces of information, such as the cost of the machine and how much profit it could produce over a specific period of time. The downside of using the payback period technique is that it does not account for the time value of money. That means that money is worth more today than it will be in the future. Money has a time value for 3 reasons. The first reason that money has a time value is that in the future you will need more money to buy the things that you buy now. This is called inflation. Money also has a time value due to uncertainty. The longer it takes you to recoup the money you have spent, the more uncertain it becomes that you'll get it back. The final reason that money has a time value is due to opportunity cost. More than likely, there will be alternative opportunities for you to invest in. Having cash in hand today to invest in another opportunity is more valuable than the cash you will receive in the future. Unlike the payback period technique, the net present value and internal rate of return do factor in the time value of money. They are a bit more complicated than the payback period to calculate, but they are more accurate. The net present value compares the outgoing cash associated with a project or investment with the discounted cash flows expected to be generated by the project or investment. For instance, assume a business owner is looking into a project requiring $243,000 of initial cash outlay. She expects the project to generate $50,000 in cash every month for 12 months. We use a discount rate of 12% per year. We have a monthly time period, so we have to divide 12% by 12 months, which gives us 1% or 0.01 per month. Based on her cost of capital, we can calculate NPV with the following formula. R sub t equals net cash flow during a single period. I equals the discount rate or return for a period. T equals the number of time periods. Many business calculators and spreadsheets will have the capability to do the summation calculation, but it can also be done by hand. So using net present value, the project will earn $562,754 minus $243,000, which gives us $319,754 in profits. Related to the net present value is the internal rate of return, which is the discount rate at which the net present value is 0. Once the discount rate is calculated, it can be compared to a hurdle rate, like 12% in the previous example, to see if the project has a greater percentage return than what it will cost. Let's review the main points of this lesson. There are several vocabulary words that you should remember. Capital budgeting is the financial analysis that corporations conduct to determine if they should pursue a potential investment or project. Cash flow is the money that goes into and out of a business. Capital budgeting decisions should be based on 3 things. How much money do we have? What is the financial impact of the opportunity? What are my criteria for investing in this opportunity? 3 capital budgeting techniques are payback period, net present value, internal rate of return.
The most basic principle in building wealth is the time value of money. The $100 in your pocket right now is worth more today than it will be in the future, but you can invest that $100 to create additional dollars. You can use different techniques to determine the best way to invest your money. Penny has $100,000 and understands the concept of the time value of money. She knows that if she invests the money, it will be worth more than $100,000 in the future. If she just put the money under her mattress, she would only have $100,000 in the future, and that $100,000 would not have the same buying power in the future as it does today because of inflation, the gradual increase of prices over time. She has it in a savings account, earning 2% interest right now, but she wants to earn more. In order to earn a higher rate of return, Penny decides to invest in residential rental property, and she identified 2 prospective properties in her price range, a single-family home and a multifamily duplex. The single-family home costs less than the duplex, but the duplex provides a higher annual cash flow. Penny evaluates the viability of each option using a net present value (NPV) calculation. The NPV calculation adjusts the future annual cash flows of each investment to today's value using a discount rate. The discount rate is the rate by which the value of the future cash flows is reduced. This rate corresponds to the rate of return Penny wants to earn on this investment as compared to the interest rate she earns from her savings account. If Penny had to borrow the money to purchase the investment property, she would pay interest on the loan. Her discount rate would have to be higher than the interest rate on her loan to ensure her investment return is enough to cover the cost of the financing. In Penny's case, she wants her new investment to generate at least a 10% return in order to make it worthwhile. She is only earning 2% in her savings account, so a 10% return would account for the higher risk in the real estate investment than a savings account. Penny uses 10% as her discount rate to calculate the net present value of the future cash inflows, less her initial cost outlay. The NPV allows Penny to compare the future cash flow of each of the investment options less her initial cost in today's dollars. If the NPV is positive, it meets her investment requirements, 10% return. If the NPV is negative, the investment does not meet her 10% return requirements, and she is better off looking for another investment option or leaving her money in the bank. Lucky for Penny, both investment options return a positive number and will provide at least a 10% return. But how does Penny decide which property to buy? The initial costs and annual cash flows are different for each property, and she only has $100,000 to spend and cannot buy both properties. The least cost principle says that Penny should select the investment property that gives her more value for the money she invests. Penny uses a Project Profitability Index (PPI) calculation to see which project follows the least cost principle and gives her the biggest bang for her buck. A result greater than 1.0 indicates the investment exceeds her requirement return of 10%. The higher the PPI, the more value Penny receives for each dollar invested. Penny compares the PPI for each property to decide if she should spend $100,000 on the duplex to get higher annual cash flow, or spend $50,000 on the single-family home to get the same return, slightly lower cash flow, but have an extra $50,000 to invest elsewhere. The PPI is calculated by dividing the NPV of only the future cash flows into the initial cost of the property. Penny takes her original NPV calculation and adds back the cost of each property to perform the PPI calculation. Investment property number 1 returns a PPI of 1.2, while number 2 returns a PPI of 1.1. Penny decides to invest in property number 1 because she gets more value for each dollar spent, and she has an additional $50,000 to invest elsewhere. Property number 2 provides the required rate of return, but it is not as profitable an investment as number 1 because it costs more to invest in it. Property number 1 is the least cost investment option. In this lesson, we explored the basic principles of wealth building to evaluate the viability and profitability of investment opportunities. The time value money concept is based on the premise that $100 in hand today is more valuable than $100 promised in the future, unless it is invested. With so many different investment options available, the net present value method is used to evaluate the viability of each option. The discount rate, otherwise known as your expected return, is used to reduce the future cash flow of each option to calculate the net present value. When there are multiple options with a positive NPV and limited funds, the least cost principle dictates that the opportunity that provides the greater value for the money invested should be selected. A Project Profitability Index provides the means to compare the profitability of two investment options and evaluate which one gives a bigger bang for the buck.
Mr. Yu Brew owns the Aroma Coffee Company, and he's evaluating the purchase of a piece of machinery that will allow him to double his current capacity. Mr. Brew would like some help evaluating this purchase. Capital assets are usually items that are acquired specifically to help the business make more money. Such property, like machinery and equipment, typically require a business to spend some serious cash. Companies must determine whether the money spent will pay for itself over time by generating cash flow for the company. Let's examine two methods to assess Mr. Brew's decision, the payback method and the simple rate of return method. The payback method, or payback period, calculates how long in years it will take the company to recover its original investment. It also considers the amount of cash inflow that the company expects to generate as a result of the investment. The shorter the payback period, the better the investment. The formula for calculating payback method or payback period is payback method equals cost of the investment divided by annual cash inflow. Let's assume that the coffee machine Mr. Brew wants to buy costs $750,000, and he anticipates that the new machine will result in annual cash inflow of $125,000. Let's calculate the payback period for this investment. We want to divide the cost of the investment by the annual cash inflow. $750,000 divided by $125,000 equals 6. Therefore, it would take Mr. Brew 6 years to recover his investment in the coffee machine. While this method represents a quick way to determine how long an investor's money is at risk, it does have some shortcomings. For example, it does not consider the time value of money. We know that $1 today is not the same as $1 6 years from now. It also does not consider future profitability generated by the capital asset. Once Mr. Brew reaches the 6-year mark, we can assume that the machine will still contribute to this company's overall profitability. This is not reflected in the payback method's calculation. Lastly, this method assumes that cash flows will be the same over the life of the asset. Assets are generally more efficient and productive when they're new, meaning that the contribution to cash flow would be greater in the earlier years of the asset's use. The simple rate of return, also known as the accounting rate of return, measures the amount of profit generated as a percentage of the original investment. The calculation considers the incremental revenue and costs of the investment. Revenue represents the amount of money generated by selling a company's products. For Mr. Brew's company, this is the money from selling the additional coffee beans that can be processed using the new machine. The formula for calculating the simple rate of return is simple rate of return equals incremental revenue minus incremental costs divided by amount of investment times 100. Let's assume that Mr. Brew anticipates that the new machine will generate $100,000 in additional revenue and $25,000 of depreciation expense will be taken on the machine every year. Depreciation is an expense that recognizes the amount of the asset that's used up over its useful life and will serve as the incremental cost in this example. The simple rate of return for his investment would be $100,000 minus $25,000 divided by $750,000 times 100. Therefore, his simple rate of return is 10%. The numerator could also be expressed as incremental net income, which is revenue less expenses. The investment should be considered if it's greater than the Aroma Coffee Company's minimum desirable rate of return, which is also known as its hurdle rate. This method has some disadvantages as well. Just like the payback method, the simple rate of return does not consider the time value of money in its calculation. In addition, this method uses net income and not cash flow to calculate the rate of return. Net income can fluctuate from year to year for reasons that have nothing to do with the purchase of new equipment. Cash flow is deemed to be a better measure of an investment's profitability. Lastly, this method assumes that the amount of net income will be consistent year after year, when this is not realistic. Capital assets are usually items that are acquired specifically to help the business make more money. They can require a large cash expenditure by a company. A business needs to ensure that the amount it's spending will pay off in the end with greater revenue and net income, revenue less expenses. It's also interested in the length of time it will take to recover its original investment. The payback method allows management to quickly determine how many years it will take to recover the money they'll spend to purchase a capital asset. Payback method equals cost of the investment divided by annual cash inflow. The simple rate of return determines the percentage return on investment that the business would get because of the additional income the capital asset would generate. Simple rate of return equals incremental revenue minus incremental costs divided by amount of investment times 100. It's important to note that neither method considers the time value of money. Management should not base its investment decision on only one measure, but rather on several different calculations, one of which should take the time value of money into consideration.
Payback analysis is a mathematical methodology to determine the payback period for an investment. The payback period is how long it will take to pay off the investment with the cash flow derived from the asset or project. In colloquial terms, payback analysis calculates the break-even point. The payback period is usually measured in years. Payback analysis can provide important information for decision-making. It provides a means to manage risk. You can use payback analysis to determine whether an asset or project will pay for itself in an acceptable period of time. Shorter payback periods are usually viewed as less risky. Additionally, you can also use the method to compare potential assets or projects to see which will recoup its costs quicker. The payback method is certainly not the only financial metric that should be relied upon when making an investment decision, but it is a useful tool. Now, let's take a look at the formula necessary for payback analysis. The payback formula is simple. The payback period is the total investment required to purchase the asset or fund the project divided by the net annual cash flow, which is gross cash flow minus expenses generated from the asset or project. So the formula is payback period equals initial investment divided by annual net cash flow. Now that we know the formula, let's take a look at an example and use our payback formula. Let's say that you're the vice president of the operations department of a manufacturing company. You're currently considering whether to purchase machine X or machine Y. Machine X costs $100,000 and has a projected annual net cash flow of $25,000, while machine Y costs $150,000 and has a projected annual net cash flow of $45,000. You must calculate the payback period for each, which will determine which machine you will purchase. Begin with the payback formula. Payback period equals initial investment divided by annual net cash flow. Then plug in and solve the values for machine X. Payback period for machine X equals $100,000 divided by $25,000, which equals 4 years. Now plug in and solve the values for machine Y. Payback period for machine Y equals $150,000 divided by $45,000, which equals 3.3 years. The payback period for machine Y, 3.3 years, is shorter given the annual net cash flow, so that is the machine you select to recoup your initial investment as quickly as possible, even though the initial price is higher. Let's now assume that machine X costs $1 million and has projected net cash flow for 8 years at $270,000, $250,000, $320,000, $290,000, $220,000, $350,000, $230,000, and $330,000 from year 1 to year 8, respectively. This is a mixed annual net cash flow. To get the payback period, we calculate as follows. You can see that the amount of $1 million is recovered between year 3 and year 4. Thus, payback period equals 3 plus $290,000 minus $320,000 divided by $1,130,000 minus $840,000, which equals 3.103 years. Payback analysis is a financial metric that is used to determine the amount of time it takes for an investment to pay for itself. The analysis can be used to determine the level of risk an investment presents to an organization. The payback period can be calculated by dividing the cost of the initial investment by the net annual cash flow generated by the investment.
It's no surprise that many items we, as consumers, have come to love and want are produced in a factory with the use of machines. We also know that those machines need to run efficiently in order to keep up with the demand. But what happens when those machines no longer work as well as they used to? What happens when those machines cannot meet the production demand necessary to keep consumers supplied? Well, for most companies, when a machine is not efficiently working, they're willing to spend money to replace it. Initially, companies will lose money because the cost of the machine has to be deducted from their profits. In the long term, however, the money spent is actually an investment that will help future production. That investment is what economists refer to as investment spending. So, what do I mean by the term investment spending? Well, investment spending is an attempt to stimulate production by means of capital goods that are either created or acquired. But what is meant by the term capital goods? In simple terms, capital goods are a company's assets, like machines or other equipment, that are used or needed to make other goods. In our example from earlier, the machines used to produce the products we love are capital goods. Investment spending is done in hopes that the costs incurred will eventually produce long-term benefits. Companies, individuals, and even the government partake in investment spending. Investment spending comes in two forms. 1, replacement. Obviously, machines and equipment fail or break down. When this happens, those machines need to be replaced. This type of investment spending is called capital consumption and is the product of depreciation. 2, new purchases. In some cases, companies don't spend their money on replacing an old machine, but rather purchase additional ones. This is because more machines means greater output and productivity. In the long term, this type of investment spending helps make a company more competitive while increasing profits. But how is investment spending calculated? Well, for starters, it's important to explain the terms found within the calculation. They are as follows. Gross investment, when both types of investment spending explained earlier, new and replacement spending, are combined together. Depreciation, a decrease in value as time progresses because of normal wear and use. When you put them all together, you get the following equation. Investment spending equals gross investment minus depreciation, or investment spending equals all types of spending, replacement and new, minus the depreciation of any items being repaired. Let's apply it to an example. Let's say the city of Denver has 10 city buses that are not running well and decides to replace all 10 buses. The city also decides to purchase 3 more buses in order to expand and cover new developing neighborhoods. When we plug these numbers into the equation, we get 10 replacement buses plus 3 new buses equals 13, gross investment. The gross investment is a combination of new and replacement spending. Replacement investment is a product of depreciation, so because the city replaced 10 buses, depreciation equals 10. When you combine the two within the formula, you get investment spending equals 13 minus 10. Therefore, investment spending equals 3. Investment spending is a term that refers to an attempt to stimulate economic production by means of created or acquired capital goods. Capital goods are those goods, like machines or equipment, that are used to create new goods. In order to calculate investment spending, you simply subtract depreciation from gross investment.
Companies are always looking at ways to expand their operations to make sure that they are as profitable as possible. This means constantly analyzing new possibilities for capital investments, which are investments that, despite not being turned into something that is produced by the company, are useful for increasing profits. As you might expect, there are plenty of plans that are put forward to help a company make more money. How is a decision maker supposed to sort through them all? Luckily, there is a solution. The simple rate of return method allows companies to quickly calculate a simple rate of return. A simple rate of return is how much a company expects to make off of a capital investment every year. Using this figure, a company can quickly see if a plan is worth its time and money. Calculating the simple rate of return is just as straightforward as you'd imagine. Simply divide the expected yearly profit of the upgrade by the total cost of the upgrade. By doing so, you'll end up with a decimal that you convert to a percentage. This percentage is the simple rate of return. However, without guidance, it is relatively useless. A company has to have a well-developed plan in place in order to make use of the simple rate of return. As we've mentioned, a simple rate of return is just a number, unless a company has some idea of how to use it. Again, depending on the company, the guidelines for using the rate could be very different. Some companies allow their managers to spend up to a certain point on a plan that has received a favorable simple rate of return. For other companies, it is merely a starting point for a more involved examination of the suggested upgrade or purchase. Despite its simplicity, the simple rate of return method is far from perfect. For starters, it assumes that the same profit will be made every year. This is rarely the case. Additionally, the simple rate of return doesn't factor in the fact that money could be better spent elsewhere. A project with a simple rate of return of 15% looks like a much worse investment if the money spent on it was actually earmarked to pay for production-related expenses. Chances are a company in this situation will have a problem staying around for the project to pay itself off. In this lesson, we looked at the simple rate of return method of calculating the practicability and profitability of a capital upgrade. We started by learning that the simple rate of return method takes into account the simple rate of return when making capital planning decisions. Remember that the simple rate of return is simply the annual increase in income divided by the total cost of the project. Different companies have different strategies for how to best use the data gained from performing the simple rate of return calculations. However, no matter how they use it, the method does suffer from disadvantages resulting from its simplicity.
Nikki is a manager of finance at Star and Moon accounting firm. Her boss has asked her to give a presentation to newly hired financial analysts on financial statement analysis. The following week, Nikki started her presentation by asking the new hires, "What are the main financial statements?" One new hire raised her hand and said, the income statement, the balance sheet, statement of owner's equity, and the statement of cash flow. Nikki said, "Excellent. You know the basic financial statements. Now, what is financial statement analysis?" There was a blank stare on the faces of the new hires. No one raised their hand, so she said, "Financial statement analysis involves using two or more line items from a financial statement, which forms a ratio, to make calculations and interpret results. Financial statement analysis is categorized by liquidity, debt, and profitability. Each of you here will be assigned a category and will be responsible for calculating and analyzing ratios in that prospective area. For the remainder of this lesson, we'll discuss each financial statement ratio category, show an example of each, and look at how to analyze the calculated results." Nikki started explaining liquidity by asking the new hires, if a business needed to purchase supplies, which asset could they turn into cash the fastest, a savings account or inventory? We all said in unison, "A savings account." She then called on a new hire on the back row and asked why. He answered by explaining that all a business would have to do is go to the bank and withdraw the money, but with inventory they would have to wait for it to sell to get the cash. Nikki replied excitedly, "Absolutely. Liquidity is our ability to turn assets into cash." Let's look at an example of a liquidity ratio, the current ratio. Current in this instance means short term, less than a year. The current ratio is calculated by taking current assets divided by current liabilities. Assets are items the business owns, such as a truck, and liabilities are obligations the business owes, such as a loan. The current ratio tells us how well we're able to pay our current liabilities by liquidating our current assets. The higher the result, the better we're able to pay our liabilities or obligations. This analysis is important to determine how well we're able to pay our obligations with what we own. So, given that current liabilities are $545,000 and current assets are $1,145,000, let's calculate the current ratio. The current ratio equals current assets divided by current liabilities, or $1,145,000 divided by $545,000. The answer is 2.1. Now let's look at debt ratio. The debt ratio explains what percentage of our assets are financed with loans. Nikki went on to say, "Remember, assets are items we own, such as a truck, and a truck loan is considered a liability or debt. To calculate the debt ratio, you take total liabilities divided by total assets. But remember, you don't just use one asset or one liability, but all of them. The higher the percentage, the more of your assets are calculated with debt. In other words, the higher the percentage, the less of the asset you own. This ratio would be important to determine how much debt a company is in and if they're in a solid financial position to take on more debt. Given that the total liabilities for XYZ Limited were $2,345,000 and the total assets were $4,350,100, let's calculate the debt ratio. Debt ratio equals total liabilities divided by total assets, or $2,345,000 divided by $4,350,100. The answer is 0.539, or 53.9%. Just as important as debt is profitability. A business must make a profit after all. That's what they're in business to do. Nikki told the new hire she had one more ratio to review. She started her last point by asking, which financial statement shows profitability? They all replied, income statement. She said, exactly, the income statement shows how much profit we made for a particular period of time. Profitability ratios evaluate business profits as it relates to sales, assets, or investments. An example of a profitability ratio is operating profit. The operating profit ratio measures the percentage of profit earned on each dollar of sales. It's calculated by taking profit divided by sales. This ratio is important to understand because when a business makes sales or revenue, they pay out some of those monies in expenses. The operating profit margin shows us what percentage of that money is actual profit. Of course, the higher the ratio, the more of each sale we keep for profit rather than paying out in expenses. As an example, if we knew the operating profit was $45,000 and sales revenues were $145,000, what is the operating profit ratio? The operating profit ratio equals the operating profit divided by sales revenues, or $45,000 divided by $145,000. The answer is 0.3103, or 31.03%. Nikki concluded the presentation by telling the new hires they've been a great group, and she thought they would do a great job as financial analysts. It's important to be familiar with the four main financial statements, which are the balance sheet, income statement, statement of owner's equity, and statement of cash flow. Financial statement analysis involves using two or more line items from a financial statement, which forms a ratio, to make calculations and interpret results. Financial statement ratios are categorized in three main areas: liquidity, debt, and profitability. An example of a liquidity ratio is the current ratio. It shows how well we're able to pay our current liabilities with our current assets. The current ratio is calculated by taking current assets divided by current liabilities. If we have a high current ratio, we're able to pay our obligations well with our current assets. The next ratio is the debt ratio. It explains how much of our assets are financed with loans. It's calculated by taking total liabilities divided by total assets. The higher the ratio, the less of the asset we own. Lastly, we discuss the operating ratio as a profitability ratio. The operating ratio measures the percentage of profit earned on each dollar of sales. It's calculated by taking profit divided by sales. The higher the ratio, the more of each sale we keep for profit rather than pay out in expenses. In summary, it's important for you to learn whether a high ratio represents positivity or if it's negative, because each ratio analysis is different.
It's a sunny Saturday morning, and you're ready to finally fix that fence. You decide that you'll need a screwdriver and some wood screws. You search through your toolbox looking for the screwdriver with the end that looks like a star, but all you can find is the one that looks like a square. Thinking that's close enough, you get to work. You quickly realize that even though you have the right tool, a screwdriver, there's a limit as to how effective the one with the square head will be for this job. It's the same with financial statement analysis. It's a great tool, but sometimes it has limitations. There are a number of reasons why financial statement analysis has limitations. Some of these include using estimates when preparing financial statements, using the cost basis to value items, different accounting methods, having unusual data, what's not included in the financial statements, and how diverse a company is. Not everything in accounting is known with absolute certainty. Sometimes accountants are required to make estimates based on the best information they have at the time. For example, how long a piece of equipment will last is estimated based on how much the company thinks it will be used every year. Depreciation, or the cost of using that item every year, takes the equipment's lifespan into consideration. If the company is wrong about its estimate, for example, the equipment lasts for a shorter period of time than expected, then the accounting information will be incorrect. If the accounting information is incorrect, then any financial analysis performed using the accounting information will also be wrong. Another limitation is that items purchased by the company are recorded at cost. Accountants generally do not adjust items for increases in value, only decreases. If the economy is experiencing inflation, meaning the general price of goods goes up, then any comparison using this unadjusted data could be misleading. There are a number of different but acceptable methods permitted for things such as depreciation and inventory costing. Different methods could result in different net income calculations. Comparability between companies that use different methods would be a challenge and would require the user of the information to identify the costing methods used in each company's annual report. In addition, a company's year-end may fall during a slow time, such as summer, or a peak season, such as just after Christmas, so the balances in the financial statements may not be representative of the company's typical activity. Using these balances in financial analysis, such as ratios, could be misleading. It's important to note that while the financial statements contain lots of information, there is also a great deal of information that is not included. For example, changes in management could have a significant impact on the company's future profitability, but this information would not be reflected in the financial statements. Similarly, a major technological breakthrough that will make the company profitable in future years, or a change in government regulation that would decrease the company's future profit, would not be reflected in current financial information. Another issue is some companies operate in a number of different industries, making it difficult to classify them for comparison purposes. For example, if a company was active in the aerospace and consumer goods industries, which industry would you put them in for comparison purposes? How would they compare with the competition? Let's review. Financial statement analysis is a great tool for evaluating the profitability of a company, but it does have its limitations due to the use of estimates for things like depreciation, different accounting methods, the cost basis that excludes inflation, unusual data, a company's diversification, and useful information that is not disclosed in the financial statements, such as technological advances and management changes. It is never a good idea to rely on only one type of financial analysis when making a decision. It is always best to evaluate a company using a number of different tools to get the most complete picture of the company.
Earnings per share, also known as EPS, is a very important number in business. It tells shareholders how much money each share of their stock earned for the company. It's important because usually when a company has a high earnings per share, it also has a high stock price, which makes investors happy. The equation for calculating earnings per share is as follows. Earnings per share equals net income minus preferred dividends divided by number of common shares outstanding. Net income. One of the factors used to figure earnings per share is the company's net income. Net income is the profit left over after deducting the company's expenses and is sometimes referred to as net profit or the bottom line. Net income can be found on the company's income statement. We can see this on the following example of an income statement for Bob's Miniatures. In this example, the net income for Bob's Miniatures is $122,200. Preferred dividends. Preferred dividends are the second item used to calculate earnings per share. Dividends are a share of the profit that is sometimes paid to shareholders. Preferred dividends are dividends paid to the owners of a class of stock called preferred stock. The preferred dividends can be found on the Statement of Retained Earnings, also called the Statement of Stockholders' Equity, or from the income statement. In the following example, Bob's Miniatures is showing $17,000 and $32,200 paid for dividends on the retained earnings statement. Common shares outstanding. The final piece of information we need to calculate the earnings per share is the number of common shares outstanding. Common shares are another class of stock. A company usually issues many more shares of common stock than it does of the more expensive preferred stock. Outstanding shares are simply shares that have been bought by stockholders. So, common shares outstanding refers to the number of shares of common stock that have been purchased by stockholders. Be careful not to confuse shares issued and shares outstanding. Shares issued means the total number of shares the company has offered for sale, while outstanding shares means the number of shares that are owned by stockholders. To figure out the number of common shares outstanding, we'll usually have to do a little extra math, using the information in the stockholders' equity section of the balance sheet. On the balance sheet, it will tell us how much money the company received for selling common shares, along with how much the shares were sold for. By dividing the total paid for the common stock by the cost per share, we can calculate how many shares are outstanding. Let's use the information from Bob's Miniatures balance sheet to figure out how many shares of common stock are outstanding. We see that Bob's Miniatures sold $200,000 worth of common stock at $1 per share. We don't have to do anything with the preferred stock in this part. Here, we only care about the common stock. So $200,000 divided by $1 per share for common stock equals 200,000 shares of common stock. Now that we have all the information we need, let's figure the earnings per share for the common stock of Bob's Miniatures using the amounts we've already discussed. Earnings per share equals net income minus preferred dividends divided by number of shares of common stock outstanding. Earnings per share equals $122,200 minus $17,000 divided by 200,000 shares. Earnings per share equals $105,200 divided by 200,000 shares. Earnings per share equals 0.526 or about 53 cents per share. Let's review. Earnings per share, or EPS, is an important number for shareholders and potential investors because it tells them how much income is generated for each share of stock. The formula for calculating earnings per share is earnings per share equals net income minus preferred dividends divided by number of common shares outstanding. Net income, or net profit, is found on the income statement. Preferred dividends paid are listed on the balance sheet. Number of common shares outstanding must be calculated using the amount paid for the common shares divided by the amount paid per share.
You are visiting your grandma, who's out of blue thread for her quilt. You offer to purchase more thread for her, but when you get to the fabric store, you're confronted with 25 different shades of blue thread. Which one should you get? Grandma needs the right color to finish the quilt properly. Just like with thread, there are many different types of financial ratios that measure different things. The ones you choose will depend on what you are trying to assess. Short-term creditors are most interested in liquidity ratios because they provide the best information on the cash flow of a company and measure its ability to pay current liabilities, or the money a company owes to its creditors. Liquidity ratios include current ratio, acid test or quick ratio, working capital, accounts receivable turnover, collection period, inventory turnover, and days sales in inventory. Let's start with current ratio. In accounting, an amount is considered current if it provides an economic benefit or is due to be paid within 1 year or 365 days. The formula to calculate the current ratio is current assets divided by current liabilities. Current assets typically include cash, short-term investments, accounts receivable, inventory, and prepaid expenses. Current liabilities include accounts payable, salaries payable, income tax payable, unearned revenue, and accrued liabilities. The current ratio measures a company's ability to pay its current liabilities with current assets. For example, a current ratio of 1.6 means that a company has $1.60 of current assets to pay every $1 of current liabilities. A current ratio should exceed 1.0. Acid test or quick ratio. The formula to calculate the acid test or quick ratio is cash plus short-term investments plus net accounts receivables divided by current liabilities. The acid test or quick ratio represents a refinement of the current ratio. By only including items that are cash or readily convertible to cash, it provides an indication as to whether a company would be able to pay all of its current liabilities if they were due immediately. Notice that inventory and prepaid expenses are not included in this calculation. Again, a healthy company should have an acid test or quick ratio of at least 1.0, such as greater than $0. The accounts receivable turnover measures how successful a company is in collecting the money owed from its credit customers. It is expressed as the number of times that the accounts receivable block was converted to cash during the year. It is helpful when used in conjunction with the collection period ratio. The higher the number, the more successful a company has been in converting the money owed to cash. The formula to calculate the accounts receivable turnover ratio is net credit sales divided by average accounts receivable. The average accounts receivable ratio is calculated by adding last year's and this year's accounts receivable balances together and dividing it by 2. Let's look at an example. An accounts receivable account had a balance of $120,000 in year 1 and a balance of $100,000 in year 2. Total net credit sales totaled $800,000. The accounts receivable turnover would be 7.27, 800,000 divided by 120,000 plus 100,000 divided by 2. Collection period ratio. The formula to calculate the collection period ratio is 365 days divided by accounts receivable turnover. The collection period ratio measures the number of days that the credit sales were outstanding or not collected. The measure varies from company to company and should be compared with a company's own credit policy. For example, if a company had a credit policy requiring customers to pay up in 30 days and its collection period ratio was 23 days, we would conclude that the company was doing a great job of collecting its outstanding receivables. If, however, the collection period ratio was 45 days, we would conclude that the company was not being efficient in collecting its outstanding receivables. Inventory turnover. The formula to calculate the inventory turnover ratio is cost of goods sold divided by the average merchandise inventory. The average merchandise inventory is calculated by adding last year's inventory balance and this year's inventory balance together and dividing it by 2. The inventory turnover ratio measures the number of times that a business has been able to sell and replace its inventory during the last year. Inventory can be a significant cash outlay for a company, and the faster it is able to sell it and collect the cash, the better for the company's cash flow. The higher the number, the more efficiently the company manages its inventory. Days sales in inventory. The formula to calculate the days sales and inventory ratio is 365 days divided by inventory turnover. This formula measures how many days it takes a company to sell its inventory, and represents a calculation that can be easily compared with other companies in the same industry. There are many financial ratios that provide information on different aspects of a company. A short-term creditor would be most interested in liquidity ratios, which can provide information on a company's liquidity and how quickly it can convert items such as accounts receivable and inventory to cash. Liquidity ratios include current ratio, acid test or quick ratio, working capital ratio, accounts receivable turnover ratio, collection period ratio, inventory turnover ratio, and days sales in inventory ratio.
You will likely notice the same answer coming up over and over. One of the biggest reasons businesses fail is because they don't have enough cash on hand to satisfy their short-term operating expenses. These businesses may have had a great idea, a great location, and some great people on their team, but they didn't manage their short-term cash needs effectively and failed. When accountants, top-level executives, and financial analysts want to make sure a company is on solid ground, there are a few quick things they can look at. One of those financial metrics is known as a current ratio. The current ratio is a measure of how well a company can meet its short-term obligations. Short-term obligations are usually debts or liabilities that need to be paid in the next 12 months. In accounting terms, the current ratio is the ratio of current assets to current liabilities and is often described as the liquidity of a company. To be classified as a current asset, the asset must be cash or able to be easily converted into cash in the next 12 months. Current liabilities are any amounts that are owed in the next 12 months. For a more advanced understanding, we recommend additional study on the individual components that make up current assets and current liabilities. It's important to note that the current ratio may also be referred to as a liquidity ratio or working capital ratio. The current ratio formula is calculated as follows. Current assets divided by current liabilities. Current assets equals cash plus accounts receivable plus inventory plus prepaid expenses. Current liabilities equals short-term notes payable plus accounts payable plus payroll liabilities plus unearned revenue. In the most simple terms, the current ratio helps internal and external individuals see how likely the company is to have issues paying its bills. Remember, this is one of the main reasons companies fail. The higher the current ratio, the better positioned the company is to operate smoothly in the future and have no issues paying their bills in the next 12 months. A ratio over 1 means that a company has some cushion to handle potential unforeseen expenses that might arise. As an employee, looking at the current ratio might be a good idea to let you know whether your future paychecks are safe. A ratio under 1 implies that if all the bills over the next 12 months came due immediately, the company would not be able to pay them all off, only a percentage of them. To get a better idea of this in action, let's look at an example. If a company's current assets are $100,000 and its current liabilities are $50,000, the current ratio is 2 to 1. This means that if all the bills for the next year came due tomorrow, totaling $50,000, the company could pay them all off twice with its $100,000 in assets. This gives investors and managers assurance that the company is in a good position to pay the bills. If the current assets are $100,000 and the current liabilities are $300,000, the current ratio is 1 to 3. This should raise concerns that the company may have a hard time meeting its short-term obligations. They may only be able to pay 33.3% of their bills if they all came due. This certainly doesn't mean that a company will go bankrupt, but is simply something to be aware of and investigate further. One of the most important parts of a business is its inventory. Businesses need to be able to keep track of how long it takes to convert inventory into cash because it affects performance. Inventory turnover is used by firms as a way to understand how they're performing over time and relative to other firms in the same industry. Once they know how they compare to other industries and how long products take to sell, changes can be made to improve efficiency and profitability. Inventory turnover may be defined as how fast a business sells its products within a specific period of time. Although it's possible to calculate how fast this happens in a day, week, or month, inventory turnover most often refers to an annual rate of turnover. There are two formulas used to calculate inventory turnover. However, this lesson will focus on the most common formula. Inventory turnover equals cost of goods sold divided by average inventory. Cost of goods sold, or COGS, is the annual cost a business spends to produce goods and encompasses every cost associated with making the finished product. The cost of direct labor and raw materials are examples of costs included in COGS. The average inventory is calculated by totaling the annual sum of inventory and averaging it out. Inventory varies at different times of the year. During Christmas or other holiday periods, for instance, retailers are more likely to forecast greater demands for products and increase inventory to meet increased demand. Using the average annual cost of inventory allows businesses to minimize the impact of seasonal inventory variances and get a more accurate understanding of inventory turnover. Calculating inventory turnover is simple once you know where to obtain the necessary data. COGS can be found on the income statement. Average inventory is when monthly inventory is totaled and averaged and is obtained from the income statement. Company XYZ is having trouble balancing supply and demand. They want to look at their inventory turnover so that they can increase their efficiency. According to their balance sheet and income statement, we get these figures. COGS equals $250,000. Average inventory equals $35,950. Inventory turnover equals $250,000 divided by $35,950. Inventory turnover equals 6.95. This means that company XYZ's product is sold 7 times, 6.95 is rounded up, per year. This could be a good or bad thing depending on the industry. Grocery stores, for instance, should have a much higher rate of turnover than a furniture manufacturer. Grocery store products have a shorter shelf life than furniture and a smaller gross profit, the difference between the cost to produce the product and what it's sold for. Therefore, an inventory turnover rate of 7 may be considered low if company XYZ is a grocery store and high if it's a furniture store. Another factor involved in understanding company XYZ's inventory turnover is how it compares to other firms in the same industry. An inventory turnover of 7 may be considered high or low compared to how others are doing. Low inventory turnover means sales are low. Inventory takes longer to sell and cost more to store. High inventory turnover means that products are in demand and sales are high. When inventory turnover is high, this implies that a business is efficient at converting their inventory to cash. Inventory turnover is a management tool used to understand how long it takes for a business to convert its inventory to cash. There are 2 formulas used to calculate inventory turnover, but the most commonly used formula is inventory turnover equals COGS divided by average inventory. A high inventory rate indicates that sales are high and your product is in demand. A low inventory turnover indicates that demand is low and sales are low.
In accounting, the term liquidity is defined as the ability of a company to meet its financial obligations as they come due. The liquidity ratio, then, is a computation that is used to measure a company's ability to pay its short-term debts. There are 3 common calculations that fall under the category of liquidity ratios. The current ratio is the most liberal of the 3. It's followed by the asset ratio and the cash ratio. These 3 ratios are often grouped together by financial analysts when attempting to accurately measure the liquidity of a company. The current ratio indicates a company's ability to pay its current liabilities from its current assets. This ratio is one used to quickly measure the liquidity of a company. The formula for the current ratio is current ratio equals current assets divided by current liabilities. Note that this formula considers all current assets and current liabilities. Current assets are those assets that are expected to turn into cash within 1 year. Examples of current assets are cash, accounts receivable, and prepaid expenses. Also included in this category are marketable securities, such as government bonds and certificates of deposit. Current liabilities are those debts that are expected to be paid or come due within a year. Examples of current liabilities are accounts payable, payroll liabilities, and short-term notes payable. Look at the following example. Company A has the following information listed on its balance sheet. Current assets, $50,000. Current liabilities, $25,000. What is the current ratio for Company A? Again, remember the formula, current ratio equals current assets divided by current liabilities. So if the current ratio equals $50,000 divided by $25,000, then the current ratio is 2 or 2 to 1. What does this mean? When interpreting the current ratio of Company A, you can see that for every dollar in current liabilities, the company has $2 in current assets. A current ratio that is better than 1 to 1 is considered good. The higher the ratio, the better the financial position of the company. Company A is in sound financial position, and the current ratio of 2 to 1 indicates that they can pay their short-term obligations. The second ratio that we'll discuss is the acid ratio. This ratio is also referred to as the quick ratio. The purpose of this ratio is to measure how well a company can meet its short-term obligations with its most liquid assets. Remember, liquid assets are those that can be quickly turned into cash. Most of the current assets are highly liquid, with the exception of inventory, which often takes a longer amount of time to turn into cash. The formula for calculating the acid ratio is acid ratio equals cash and cash equivalents plus short-term investments plus accounts receivable divided by current liabilities. Cash and cash equivalents refer to such things as cash on hand, checking accounts, savings accounts, and money market accounts. Short-term investments are any investments that will mature within 90 days, such as U.S. Treasury bills and commercial paper. Let's look back at Company A. If the balance sheet for Company A gave us the following information, what would the acid ratio be? Cash and cash equivalents, $20,000. Short-term investments, $5,000. Accounts receivable, $10,000. Inventory, $15,000. Current liabilities, $25,000. The formula, again, is acid ratio equals cash and cash equivalents plus short-term investments plus accounts receivable divided by current liabilities. So then, the acid ratio equals 20,000 plus 5,000 plus 10,000 divided by 25,000. And so, the acid ratio equals 35,000 divided by 25,000, which means the acid ratio equals 1.4 to 1. Interpreting the acid ratio for Company A shows us that for every $1 in liabilities, the company has $1.40 in liquid current assets. This ratio, like the current ratio, shows that Company A is in excellent financial position because it not only has enough assets to pay its short-term liabilities, but it also has money left over. The final liquidity ratio that we'll discuss is the cash ratio. Of the three ratio calculations, the cash ratio is the most stringent measurement of a company's liquidity. The cash ratio focuses strictly on the cash and cash equivalents of a company. Accounts receivables, inventory, and prepaid expenses are not as easy to convert to cash as cash equivalents are, thus are not considered for this calculation. The formula for the cash ratio is cash ratio equals cash and cash equivalents divided by current liabilities. Look at the balance sheet information for Company A again. What is the cash ratio for this company? If the cash ratio equals $20,000 divided by $25,000, then the cash ratio equals 0.80. Notice that the cash ratio is much smaller than the other two ratios. In analyzing the cash ratio, any ratio greater than 0.5 to 1 is considered good. In this case, the cash ratio is 0.8 to 1, meaning that for every dollar in current liabilities, there are 80 cents in current assets. Once again, analysts would say that Company A is financially sound. Financial analysts, potential investors, and potential creditors all use liquidity ratios for the same purpose. They want to know if a company has enough liquid assets to meet its debt load. Companies that have higher liquidity ratios are able to meet their debt load and are safer investments. Companies with lower liquidity ratios may very well be in danger of financial ruin. Liquidity ratios are also excellent tools for companies to use when performing company self-evaluations. Knowing the correct way to calculate each ratio and what each ratio means is a vital part of the financial world.
It's Saturday morning, and you're busy getting ready for the dinner party you're hosting this evening. You've set the menu, completed your grocery shopping, and now you have to shop for wine. When you get to the store, you realize there are many different kinds, and that they seem to be classified by color, including white, red, and rosé, by type of grape and region, such as Merlot, Zinfandel, and sparkling, and by sweetness, such as dry, sweet, and semi-sweet. Which one should you choose? After consulting a knowledgeable shopkeeper, you determine that a dry white wine will go best with the main course you're serving. Selecting a financial ratio can also be complicated. Like with wines, there are many different types to choose from, including profitability, liquidity, solvency, and efficiency ratios. So how do you decide which one to choose? Well, which one is best to use depends on what you're trying to analyze. In accounting, long-term is considered any period of time greater than 1 year, or 365 days. So a long-term creditor would be most interested in solvency ratios. Solvency is defined as a company's ability to satisfy its long-term obligations. The 3 critical solvency ratios are debt ratio, debt-to-equity ratio, and times interest earned ratio. Let's take a look at each of them. The formula for calculating the debt ratio is total liabilities divided by total assets. Liabilities are items that a company owes to others, such as debts, and assets are items that a company owns, such as cash and equipment. The debt ratio measures the proportions of a company's assets that have been financed by debt. A company with a high debt ratio, such as one greater than 0.70 or 70%, may find it difficult to obtain additional financing. External lenders would be cautious when providing funds to a company with such a high ratio and would likely charge a higher rate of interest on any borrowing to compensate them for assuming additional risk. For example, let's assume that an organization, the DMS company, has total liabilities of $275,000 and total assets of $500,000. The debt ratio would be 55%, or $275,000 divided by $500,000. The debt ratio also has a complement ratio, known as equity ratio, and it measures the proportion of assets that have been financed by shareholder funds. The formula for the equity ratio is total equity divided by total assets. Since we know from the accounting equation that liabilities plus equity equals assets, then the debt and equity ratios must add up to 1.00, or 100%. External lenders generally prefer a higher equity ratio because it shows owner commitment to the business, thereby decreasing some of the risk of lending. The formula for calculating the debt-to-equity ratio is total liabilities divided by total shareholders' equity. The debt-to-equity ratio measures a company's debts compared with the funds that have been provided to it by shareholders. It's used as an indicator of how a company has financed its growth. A high ratio indicates that the company has assumed greater risk by financing its growth with debt, which it must repay with interest. Debt-to-equity ratios vary from industry to industry, so comparisons are most relevant when they're between companies within the same industry. Let's assume that our DMS company has total liabilities of $1 million and total shareholders' equity of $250,000. The debt-to-equity ratio for this company would be $1 million divided by $250,000 equals 4.0. DMS will present a greater risk in the banker's eyes than a company with a debt-to-equity ratio of 2.0 or 3.0, since bankers don't like debt. The formula for calculating the times interest earned ratio is income from operations divided by interest expense. The times interest earned ratio measures the number of times that a company's profit could be used to pay the interest expense on its outstanding debt. The higher the ratio, the easier it is for a company to pay its interest. A low ratio could indicate that a company is having difficulty in meeting its interest obligations. Let's assume that the DMS company has income from operations of $50,000 and a total interest expense of $5,500. The times interest earned ratio would be 9.1, or $50,000 divided by $5,500. As with any analysis, a number of ratios should be calculated to get a complete picture of the company at a point in time. Long-term creditors are most interested in a company's ability to pay its obligations into the future. Solvency ratios provide information that long-term creditors can use to assess the risk of lending to a company. Solvency ratios include the debt ratio, which measures the proportion of a company's assets that have been financed by debt, the debt-to-equity ratio, which measures a company's debts compared with the funds that have been provided to it by shareholders, and the times interest earned ratio, which measures the number of times that a company's profit could be used to pay the interest expense on its outstanding debt.
A value chain is a way to look at two different types of business activities, the first action that creates value for a customer, and the following action that supports the execution of the first action. For instance, a grocery store may determine that offering grocery delivery is the first action that will create value for the customer. The following actions that support the grocery delivery may include online ordering, same-day delivery, and scheduling automatic weekly delivery. These multiple activities are linked together to create value for the customer. When analyzing a value chain, it is important for a company to evaluate which actions are most valuable to the customers, providing the greatest level of satisfaction and convenience. Once the company has determined what customers truly want, they must analyze whether the activities are feasible and can be provided for their customers. Once it is determined the service or action is feasible, the company can create an action plan of value chain activities to deliver the service. The value chain analysis doesn't end there. A proactive company will review the value chain activities and see if the customers are satisfied with the results. There may be new steps that can be added or altered in the value chain that will make the process smoother or offer greater value, thus strengthening the effects of the value chain. Let's say that you are a manager of a specialty kitchen store. Customers come to you for cool gadgets and new kitchen accessories. However, you believe you can increase sales if you can show customers new ways to use the products in your store. You meet with your management team and discuss the value chain activities that can help your customers understand how to use your products, or innovative ways to cook with the items you sell. As a result of the meeting, your team determines 3 different activities your store can do to increase demand for its products. First, you will offer in-store samples and demonstrations. These will be 3 to 5 minute presentations that show 1 or 2 ways to use a product, thus creating more demand for customers. Another step you will take is offering weekly classes that will show several different products and cooking techniques. This will give your instructors a chance to share complementary items, increasing the likelihood that customers will purchase multiple tools. Finally, you will offer short videos that teach customers how to create exciting dishes with the items in your store. These videos will be linked to the products on your website, and customers can order the items easily right after viewing the video. A value chain is an effective way for managers to evaluate what needs exist in the business and create solutions for those needs. While evaluating the opportunities, a business must first determine what their customers need or want. Once the core issue is understood, a series of steps can be developed to support the original need and ensure the need is met. By using a value chain, managers can solve problems and offer solutions for their customers and stay ahead of their competitors.